Hi everyone, and welcome back to the Independent Dollar. Today we're going to be taking a look at RRSPs in 2020. What are our new limits, reasons to consider using RRSPs, and some common misconceptions about these accounts that can actually turn into costly mistakes. Today's video is part of a January series focusing on savings and retirement. I'll be releasing a new video for you every Tuesday and Thursday with new tips and tools to help you. Now, if you're new to my channel, I create personal finance videos breaking down a variety of topics in a way that's easy to understand, helping you be more independent and successful with your money. So if that sounds like something that you're interested in, go ahead and hit that subscribe button and let's get started on today's topic. The RRSP has become a popular tool for Canadians who are trying to save for their retirement, and becoming more active in your retirement planning has never been more important. Now, according to a 2016 Stats Canada report, the amount of Canadians participating in an employer-defined benefit pension is actually declining. This means the responsibility is on us to make sure we're prepared for our retirement. Now, if you're new to RRSPs and you're not familiar with the basics of how they work, then I really would suggest you check out my intro video to RRSPs to see a breakdown of the basics, and I'll include a link to that right here for you. Essentially though, the RRSP is an investment account that allows you to invest your money on a tax-deferred basis, and it also gives you the benefit of a tax deduction. Now, unlike your bank account where money just sits in cash, you have the opportunity to invest in a variety of options like stocks and bonds. This year, the limit that we can contribute to our RRSPs has changed. RRSP limits actually have two components, the limit set by CRA and your individual limit. Now for 2020, the new RRSP limit set by CRA is $27,230. Your personal individual limit, however, is 18% of your previous year's income, up to a maximum of that CRA limit, plus any carry forward room that you might have from previous years. Now, in some cases, other factors can impact your RRSP contribution limit. So if you would like to see a detailed illustration of how RRSP limits are actually calculated, including scenarios when a pension is involved, for example, then you can check out my website, theindependentdollar.com, to see a few cases. Now that we know our limits, why should we consider investing in an RRSP account? The first reason is tax deferral. Your investments will grow on a tax-deferred basis, meaning you don't actually pay any tax on the money that you earn until you take it out of the account. This gives your money the opportunity to grow faster. Another benefit to the RRSP is being able to nominate a beneficiary. This allows your investments to bypass probate and get paid directly to your family or friends. On top of the tax deduction that you get when you make a deposit, pension splitting is another great benefit to RRSPs. Assuming you're 65 years of age or older, income from your RRSP is actually eligible to be split with your spouse. This lowers your overall household taxes. Now, if you're not familiar with pension splitting, stay tuned for my February series where I'm going to share some tax updates and tips for this year. Now, maybe up to this point, some of the information is not new to you. However, as a financial professional, I know there is unfortunately a lot of misinformation surrounding RRSPs. So now I'm going to go through some of the must-know details that everyone investing in RRSP should be aware of. The first and most common misconception is that you need to claim your deduction in the same year that your deposit was made. That is not correct. You do not need to claim the deduction just because you made a deposit. In fact, you can actually decide which year you want to deduct it based on what makes the most sense for you. So as an example, if you know you're going to make substantially more income next year, even if you made a deposit into your RRSP this year, you can choose to wait and not deduct it on your taxes until the following year. Another common misunderstanding, unfortunately, is surrounding beneficiary designations. If you or someone that you know lives in Quebec, then you need to understand that they do not recognize beneficiary designations on RRSP accounts, regardless of where the account was opened. If you have an RRSP and you live in Quebec, then you need to ensure you designate your beneficiaries in your will. Another misconception is taxation. There's a misunderstanding that it's only the income that you earn within the account that's taxable. However, every dollar you withdraw from your RRSP will be taxed. So each time you take money out of the account, think of it as writing yourself a paycheck. If you withdraw $5,000 this year, then $5,000 will be added to your taxable income. The final misconception is that you don't need to take out any money unless you actually need it, when in fact that isn't the case. Once you turn 71, your account must be converted into either an annuity or a RRIF, and once that happens, you will be required to withdraw a certain percentage every single year, and that's regardless of whether or not you need the money. This is really important to understand, as these withdrawals may actually impact your taxes payable and maybe even benefits you were previously entitled to. Now, if you're not familiar with what a RRIF is, here's a link to my video of the basics so you understand what happens once you turn 71. Well, this wraps up our first video in the January Retirement and Savings series. I would love to hear what your thoughts and strategies are for your finances this new year, so please comment below to let me know. If you liked the video, feel free to give me a thumbs up. Your support really does mean a lot to us, and don't forget to subscribe so you stay up to date with all our future videos. Thanks for watching.